the foundations of the global commercial real estate market are shifting. A confluence of factors, including the sharpest rise in interest rates for more than 40 years, recessive economies, and geopolitical uncertainty, we believe will see the largest downturn in commercial real estate since the global financial crisis 15 years ago. For investors, this may seem daunting and the outlook challenging, which is why we focused on the topic during our May 2023 Global Real Estate Forum. We discussed real estate across all four quadrants. We identified the opportunities and the risks that will arise across public and private markets in both debt and equity. Commercial real estate is far from monolithic. Sectors such as multifamily housing, offices, and retail have reacted in materially different ways. A combination of land use restrictions and high construction costs will reduce supply more than in any previous cycle, underpinning real estate values over the long term. Navigating this landscape demands a differentiated approach. Secular trends, including demographics, digitization, and decarbonisation, will play out differently across the regions, underscoring the need for a granular understanding of local market dynamics. Real estate debt has been in the spotlight. In our view, we see unprecedented potential in debt in the near term. We anticipate that reduced liquidity, pressure on fundamentals, and geopolitical tensions will cause short to medium-term distress. This is why we believe lending has emerged as the most attractive avenue of investment from a relative value perspective. Investors can benefit from high-quality assets with lower loan-to-value ratios and attractive spreads. Commercial mortgage-backed securities, whilst negatively perceived by some, may in fact offer high yields at significant discounts. We see potential in commercial real estate lending, loan portfolio sales, non-performing loans, and rescue capital. This includes newly originated debt hitting the market as many lenders retreat to the sidelines. Distressed public and private debt will be part of a wave of real estate loans maturing through 2025, including at least $1.5 trillion worth in the US alone. Private credit and special situations will gain prominence, and distressed banking sectors represent opportunities to seize market share from non-bank lenders. When we think about individual sectors and where the opportunities are for long-term growth and value for investors, we've looked at each of the regions and discussed traditional sectors like office and emerging sectors such as data centres and how these are impacted by trends. These include longer-term secular trends such as society and demographics, decarbonisation and sustainability, and digital, plus the shorter cyclical issues like political change and financial market dislocation. We anticipate multifamily housing as an investment class will reap the benefits of longer-term trends, such as urbanisation, the growing rate of household formation, and rising home ownership costs. With banks sidelined, we see attractive debt investment lending opportunities for development and value-add projects. And on the equity side, we see potential in newer properties in select urban gateway markets at less expensive entry points. In the logistics market, we've seen e-commerce grow, and this will continue to drive demand for industrial storage and distribution assets over the secular horizon. Capital values for logistics facilities have declined across mature markets, especially in the US and Northern Europe, but we expect the sector to benefit as investment flows shift from office and retail to logistics, supported by low vacancy rates and rent growth. Growth in demand for data centre capacity is among the most powerful and visible secular trends in the global economy. Demand has mushroomed with continued digitisation of economies. Digital sovereignty regulations in Europe are driving demand for localised capacity. We see growing appetite from infrastructure investors. We recommend a focus on Tier 2 and Tier 3 markets in Europe, and we also see good tactical investment opportunities in public equity markets in the US, where REITs lost about a quarter of their value in 2022, creating pricing discrepancies. Whether we live in the US, Europe, or Asia Pacific, the past few years have seen us all experience unprecedented challenges which have influenced how buildings are used. But real estate is a broad sector where investors may benefit from looking at both secular and cyclical trends across public-private markets for both debt and equity. We see the greatest opportunities in the multifamily, residential, logistics and data center sectors and believe that global platforms are best positioned to make tactical trades and exploit pricing discrepancies between public and private markets. In essence, we believe investors should take a broad approach to debt, but go narrow and deep on equity. Their focus should be on high conviction, tactical deployment into stressed and deeply discounted assets that are facing immediate liquidity pressures.